Every major AI chip stock just got crushed. Nvidia briefly lost its $5 trillion crown. Micron dropped 13% in a single day, wiping out nearly $138 billion in market value before lunch. AMD, Broadcom, Intel, Marvel, almost every major semiconductor company turned red. If you only looked at the headlines, you'd probably think the AI boom is over. But here's where things get strange. During that same week, Micron reported the best earnings in its entire history. Revenue reached $41.5 billion. Gross margins climbed close to 85%. And management publicly stated they see no cracks in AI demand. So, what's actually happening? Is this the beginning of an AI bubble bursting? Or is Wall Street simply overreacting? Because these are two very different stories. One means the business itself is falling apart. The other means investors became too excited, and prices ran ahead of reality. In this video, we're going to separate facts from fear. We'll break down why AI chip stocks have crashed multiple times recently, which companies are actually in trouble, and which ones remain incredibly strong. And most importantly, I'll show you a simple framework that professional investors use to tell the difference between a broken business and a falling stock price, because those two things are not the same. Let's begin. So, what actually caused this sell-off? It wasn't one event. It was a chain reaction, and it all started with Broadcom. In early June, Broadcom reported outstanding quarterly earnings. AI revenue reached $10.8 billion, growing 143% year over year. Those are the kind of numbers that normally send a stock soaring. But this time, the market barely cared. Why? Because Wall Street wasn't looking at the past. It was looking at the future. Investors focused on Broadcom's guidance. The company still expected strong AI growth, but it wasn't as aggressive as analysts had hoped. The business wasn't getting weaker. Expectations were simply too high. And in today's AI market, good isn't always good enough. That single earnings report triggered a domino effect. Broadcom sold off, then Nvidia, AMD, Intel, and several other semiconductor stocks followed. In just one trading session, more than $1 trillion in market value disappeared across the global chip sector. And the selling didn't stop there. A few weeks later, another headline shook the market. Reports suggested that SK Hynix, one of the world's largest memory chip manufacturers, was slowing its expansion of high-bandwidth memory production, better known as HBM. HBM is one of the most important components inside modern AI servers. It's the ultra-fast memory that allows powerful AI chips, like Nvidia's GPUs, to process enormous amounts of data. At almost the same time, the Federal Reserve signaled that interest rates could stay higher for longer. That matters because AI companies are spending billions today, expecting even bigger profits in the future. Higher interest rates reduce the present value of those future earnings. And when that happens, high-growth technology stocks usually get hit the hardest. By now, investors were asking the same question. Are these companies actually getting weaker? Or are stock prices simply correcting after rising too far, too fast? Because understanding that difference is where smart investing begins. In the next section, I'll show you one of the simplest frameworks professionals use to separate a valuation correction from a real business problem. Here's where most investors get confused. They see a stock falling and immediately assume something must be wrong with the company. But that's not always true. Sometimes the business is getting weaker. Other times, only the stock price is falling. And those are completely different situations. Think of it this way. There are only two reasons a stock usually crashes. Number one, The business is actually deteriorating. Revenue starts falling, customers leave, profits shrink, debt increases. That's called a fundamentals problem. In this case, the stock deserves to fall because the company itself is becoming less valuable. But there's another possibility. Sometimes the company is doing everything right. Revenue is growing, earnings are beating expectations. Customers keep dropping. Yet the stock still drops. Why? Because investors had already priced in perfection. Expectations became unrealistic. This is called a valuation correction. The business stays strong. The stock price simply returns to a more reasonable level. So, how can you tell the difference? Professional investors usually check three things. First, revenue and earnings. Are sales still growing? Is the company making more money than before? If yes, that's a positive sign. Second, management guidance. What is the company's leadership saying about the future? Are they confident, or are they lowering expectations? Third, valuation. Has the stock become so expensive that even great news isn't enough anymore? Those three questions can tell you far more than simply looking at a red chart. Now, let's test this framework using Micron. The stock fell about 13% in a single day. Sounds terrible, until you look at the numbers. Revenue reached $41.5 billion. Gross margins approached 85%. Earnings beat Wall Street expectations. Data center revenue, the part driven by AI, more than doubled. Those aren't the numbers of a company in trouble. They're the numbers of a company growing faster than ever. But here's what impressed investors the most. Micron signed 16 long-term customer agreements running through 2030. These aren't ordinary contracts. They're called take-or-pay agreements, which means customers must pay even if they don't use the chips. Micron has already secured $22 billion in customer commitments. That's an incredible level of visibility for future revenue. So, what does all this tell us? Micron's business wasn't collapsing. The stock price was simply correcting after an enormous rally. And that's a lesson that applies to the entire AI sector. But here's the next question. If the whole industry is selling off, which companies actually come out stronger? Because not every business in the AI supply chain plays the same game. Let's break that down next. Here's where most investors make another mistake. They treat every AI stock as if they're all doing the same business. They're not. The AI industry is actually a supply chain. Every company plays a different role. And when the market crashes, each part of that supply chain is affected differently. Let's break it down into 4 simple tiers. Tier 1. The chip designers. This includes companies like Nvidia, AMD, and Broadcom. These companies design the processors that power artificial intelligence. Nvidia remains the clear leader. Its GPUs have become the industry standard for training AI models. But Nvidia's biggest advantage isn't just its hardware. It's the software ecosystem built around it. Thousands of developers already build their AI applications using Nvidia's platform. Switching to another chip isn't as simple as buying different hardware. It often means rewriting software, retraining engineers, and changing an entire development workflow. That's why many analysts believe Nvidia still has one of the strongest competitive advantages in the AI industry. Broadcom plays a different game. Instead of selling one chip to everyone, it builds custom AI processors for some of the world's largest technology companies. That's a highly profitable business. But because expectations were incredibly high, even excellent earnings couldn't satisfy Wall Street. Then there's AMD. AMD has become Nvidia's biggest competitor in AI accelerators. While it's still smaller than Nvidia, it's steadily gaining market share, especially in data centers. The opportunity is huge, but investors still expect near-perfect execution. Tier 2. Memory manufacturers. Companies like Micron, SK Hynix, and Sandisk. AI chips are useless without extremely fast memory. Every AI server depends on massive amounts of high bandwidth memory, also known as HBM. That's why memory demand has exploded. Unlike previous memory cycles, many of these companies now have long-term supply agreements with customers. That means revenue is becoming much more predictable, reducing the traditional boom and bust cycle that the memory industry was known for. Tier 3. Equipment manufacturers. Companies like ASML, Applied Materials, Lam Research, and KLA. These companies don't design chips. They build the incredibly complex machines used to manufacture them. Think of them as selling the shovels during a gold rush. Whether Nvidia wins, AMD wins, or someone else wins, chip factories still need billions of dollars worth of manufacturing equipment. That makes this one of the most stable parts of the AI ecosystem. Finally, Tier 4, the foundries. Led by one company, Taiwan Semiconductor Manufacturing Company, better known as TSMC. Companies like Nvidia, AMD, Apple, and Broadcom all design chips, but they don't manufacture them. TSMC does. Building an advanced semiconductor factory costs tens of billions of dollars and takes years to complete. Very few companies on Earth have the technology to compete at this level. That's why TSMC sits at one of the most important positions in the entire AI supply chain. So when people say AI stocks are crashing, remember this. They're talking about dozens of completely different businesses. Some design chips, some manufacture memory, some build the machines. Others manufacture the chips themselves. Understanding where a company fits in this chain helps you understand its risks and its opportunities. Here's a question many new investors ask. If Nvidia, Micron, AMD, and TSMC are completely different businesses, why do they all crash on the same day? The answer is something called market correlation. Stocks in the same industry often move together, even when nothing changes inside the individual companies. There are three main reasons. First, large investment firms don't usually own just one semiconductor stock. They own entire portfolios, or semiconductor ETFs. So when they decide to reduce risk, they sell many chip stocks at once. Not because every company is weak, but because they're reducing exposure to the sector. Second, these companies are connected through the same supply chain. If AI spending slows, everyone eventually feels the impact. And third, investor psychology. One scary headline creates fear. Fear spreads faster than facts. Investors often sell first and ask questions later. This is why a sector-wide sell-off doesn't automatically mean every company is in trouble. Headlines tell you how investors feel. Financial statements tell you how the business is actually performing. That's why professional investors spend far more time reading earnings reports than watching financial television. So, if you're serious about investing, what should you actually monitor? You only need 4 numbers. Number 1, revenue growth. Is the company selling more than last quarter? Is growth accelerating or slowing down? Number 2, profit margins. Is the business becoming more profitable, or are costs eating into earnings? Number 3, management guidance. Listen carefully to what executives say. Are they confident about future demand, or are they becoming more cautious? Number 4, capital spending. This is the most important one. Watch the AI budgets of Amazon, Microsoft, Google, and Meta. These 4 companies spend hundreds of billions of dollars building AI infrastructure. If they continue increasing that spending, the entire AI supply chain keeps growing. If they slow down, everyone eventually feels the pressure. History gives us 2 very different lessons. During the dot-com boom, companies built massive internet infrastructure, far ahead of demand. Many failed, and investors lost billions. But there's another example. Amazon spent years investing heavily in cloud computing, long before it became profitable. That business eventually became Amazon Web Services, one of the most successful businesses ever created. Right now, no one knows which path AI will follow. That's why data matters more than predictions. So, after everything we've covered, what's the final takeaway? Is this AI correction an opportunity or the beginning of something much bigger? Let's bring everything together. So, after everything we've covered, what should investors actually take away from this AI sell-off? Is the AI boom over? Based on the data we've seen, no. The underlying businesses are still growing. Revenue is still increasing. AI infrastructure spending remains enormous. And demand from the world's largest technology companies hasn't disappeared. What actually happened was a reset. After months of incredible gains, expectations became extremely high. Investors weren't just expecting great results, they were expecting perfection. And when companies delivered great instead of perfect, stock prices corrected. That's an important difference. A falling stock price doesn't automatically mean a failing business. But that doesn't mean there are no risks. Valuations across the AI sector remain expensive. Competition is increasing. Companies are investing hundreds of billions of dollars into new AI infrastructure. If enterprise AI spending slows, or if the biggest cloud providers reduce their investment plans, the entire supply chain will feel the impact. That's why smart investors don't just watch stock prices. They watch the businesses behind those prices. So here's the framework I'd encourage you to remember. Every earnings season, ask yourself 4 simple questions. Is revenue still growing? Are profit margins improving? Is management confident about the future? And are Amazon, Microsoft, Google, and Meta continuing to spend billions on AI? If those answers remain positive, then temporary market corrections become much easier to understand. One of the biggest mistakes investors make is confusing headlines with reality. Headlines create emotion. Financial statements reveal the truth. Markets can stay emotional for days, sometimes weeks, but eventually, stock prices tend to follow business performance. That's why learning to read earnings reports, understanding guidance, and analyzing valuations is one of the most valuable investing skills you can develop. This video is for educational purposes only and should not be considered financial advice. Always do your own research and invest according to your own financial goals and risk tolerance. If you found this breakdown useful, let me know in the comments. Which company should we analyze next? Nvidia, AMD, TSMC, Broadcom, or another stock that's making headlines? I'll go through the financial statements, separate the facts from the hype, and explain the numbers in plain English. If that sounds valuable, subscribe to the channel. Every week, we'll break down another company using real data, not speculation. Thanks for watching, and I'll see you in the next video.